Tobias, thanks very much for joining us here in Frankfurt. It would be good to get your sense based on the research that you've been doing, particularly looking at the debt finance side, the debt gap. What are you seeing at the moment?
So we expect over the next couple of years to see kind of an increasing debt gap, which results from the interest rate movements we've seen right now. So debt is getting more expensive, banks are getting more restrictive on their lending principles, and that will lead to a shortfall in debt, basically, we will see in the market. We estimate it at around 31 billion over the next 7 years in Germany right now, and that will mostly come in the years 24 to 26, basically, to the market, highly concentrated on the office sector right now.
And is your sense that the office sector, therefore, is going to be slightly more problematic? And what are some of the influences of that debt gap? You know, what is that going to mean in terms of the real estate side?
The office sector has a high exposure, of course, because we have the huge price correction we've seen from the high levels we've seen end of 21, basically, with the yield increases we have seen, and also rent growth not picking up enough to kind of compensate for that. And that's the reason why the office sector is kind of in the focus right now. Also, the investor sentiment is kind of negative with all the discussions going on of home office, remote working, add on the WeWork insolvency. So that's kind of troubling on the investor demand side. And that whole picture so is kind of cloudy, and not enough capital is coming to the office market. But from the debt gap perspective, we expect that to be on the market level a drag on activity, because you don't have the equity available for new investments if you have to kind of push the capital into your gap that develop on the debt side. And also we expect to see problems on property level, of course, because not all properties will be able to refinance over the next couple of years.
And do you see that particularly influencing the development markets as well?
Right now it's focused on the development market because that's the first sector we see the exposure, but it's also a problem for existing investors in core plus funds. So if you have a long kind of horizon, you can sit some things out, of course, but if you bought in 2018, 2019, that's also some problems that can arise there, because the values in 2019, 2020 were significantly higher than now, and you will run in some of those problems, especially for funds which don't have available capital equity to invest into those problematic loans.
And just finally, obviously there's been a real block in terms of transactions in the market. When are you expecting to see, I guess, that kind of normalize, and what will that look like, particularly here for Germany?
So we see some normalization in property types like logistics and residential, where we see price expectations between buyers and sellers kind of closed. So we see activity picking up there. We don't see that gap closed in offices especially. So there's a huge gap. Buyers don't want to buy at the current prices. Sellers don't want to go down in their pricing. And we have to see when pricing will materialize. And that depends on the pressure to sell, basically. So if we see a huge pressure to sell on the financing side, for example, that will set up prices to be more attractive for new capital to come in. We don't expect a huge pickup next year, 2024, but we expect a slow pickup, and then 25, 26 will be more of a normal activity. Given that, we don't expect to come back to the 2019, 2020 levels with the huge transaction volume driven by zero interest rate policy. We expect somewhere more a long-term trend where we will hit.
Thanks very much for joining us, Tobias.